Brother in Christ, Laudetur Jesus Christus in Sequela. This is Timothy Flanders at the Meaning of Catholic. Jesus is King. Today I'm joined by Peter Holm from the Ecumen. Peter, how you doing, brother?
Very good. Thank you for having me on.
Excellent. Yeah, Peter Holm is an advisor with the Knights of Columbus, and we're going to be talking about navigating the evils of modern finance. This is a part of our series called The Lay Apostolate, which is where we discuss all things laity, all concerns that the ladies have about navigating the temporal order, taking care of your family, passing down the faith to the next generation. And on our last episode, we talked to Jacob Imam about the article that he and Marc Barnes wrote about investing in the stock market or not. And so that'll be an occasion to talk a lot about a lot of the modern financial problems and questions that Catholics have. So before we get into it, just want to remind everybody, this is all supported by an international community against the Marxists, the Meaning of Catholic Guild. So you can go to meaningofcatholic.com/register to access the guild. This is our online community that supports this apostolate. You can also have access to exclusive content. Every Friday, we have our guild family stream discussing all the most controversial issues, as well as our Mary Queen of the Home Academy. That is for high school and adult formation. We have a number of different classes being offered this semester for high schoolers and adult college, myself, as well as Edmund Mazza, Dr. Bryson. So you can go to meaningofcatholic.com/academy. And before we continue into our topic again, Holm, you want to tell us about your podcast, Ecumen?
Yeah, sure. So basically, I'm a convert to the Catholic faith. So 2015, very first Mass I'd ever been to, didn't know anything about anything, all because I had a buddy who got me to start reading the Church Fathers because I was so sure I knew everything because I was teaching constitutional history and all this other stuff. So I start reading, find out I know nothing, in fact. And then next thing I know, I'm going to Mass. My wife's going to Mass with me. And then we took sacraments in 2017. And one of the things I found is that one of the reasons I had not converted yet and that kind of held me back from the church had to do with all the misconceptions, tons of misconceptions. And one of the things we decided to do as a group in terms of myself, the guy who helped me convert, and a handful of others were just like, we got to go and try and help dispel some of the weird notions about the Catholic faith and the church that are wrong and try to help people just get to the bottom of it. And in terms of my experience, I find it's way easier when I don't have to come up with the information myself. I literally can say, hey, the Church Fathers have already done it. Just go to this website, go to this book, go to wherever, because they've already transcribed it and it's available for you. So the information's out there, just find it. And if all I have to be is a scavenger of data to go and get it to people, that was kind of what our plan was on making up the channel, which is now known as the Ecumen. So kind of a play on words. I'm not sure ecumenism works personally. So it ends up being, how do we go and get people to understand the fullness, the exclusivity, the truth, everything about the Church of Christ that he established himself. And then what does it mean to all of us and how do we live properly as Catholics? Because there's a lot of confusion out there. So if we can dispel it, that was the point of why we started the channel.
Sweet. Okay. Well, check it out, everybody. The Ecumen. So the article that occasioned this conversation for me, and this is part of my own discerning what I need to do with my own finances. So hopefully the viewers will find it helpful and we can also field any of your questions. So here's the article by Marc Barnes and Jacob Imam. That's linked below if you want to read it. They also have in the latest issue of New Polity here, they have a response to this article and their rebuttal to it. And at this point, I'm all but convinced of emptying my 401k, getting out of the stock market and looking at other options. So, Peter, can you tell us a little bit? I remember when we were talking in person, you had mentioned that modern finance is so complicated, and that's by design.
I believe so.
Tell us about some of the evils of modern finance from your perspective.
The issue right now that we have is we are living in a world, again, we would know this as Catholics, that's fallen. So we end up with a system of finance that's built on the notion of credit and ultimately debt. And our currency, the way it is established, is reducing in value every single year, the way it's set up. So if you just sat your money under a pillow, dug it, put it in a hole, wherever you're going to store it, it's going to lose value just because you put it somewhere, which means the only way that you can make money from money in this system, aside from work, they set it up, it's based on usury now, for a lack of a better term. Because what we have is it's a banking system for banks by banks, with government supporting banks to just move money around. And so then it's whoever can throw the money gets the advocacy and goes from there. So in that type of environment, we're all brought into it and we're all taught, hey, save your money, put your money into your retirement accounts, manage this, manage that, interest, it'll grow. Even though you go look at your bank account right now, you're not going to get much interest in it. You're going to have to go and put it in some other investments to go and make some return so that you can ultimately retire down the road. But the whole thing is designed with this weird transitory state or end game to it, where we have to have more money. We have to pay more bills. The bills never stop. So we're in a state of debt slavery, right along with the way the currency is designed. All of us have to be cogs in the machine to go along with it and continue playing with that debt as we're told to build our own. So it's a very messed up system from my perspective.
Yeah, that's one of the things that is causing me to not prioritize retirement accounts, at least wanting to prioritize real assets, like paying down the house, buying the car instead of car loans and whatnot, real assets and real people, because I'm concerned that the monetary system as it is, would my money even be worth, what would it be worth in 30 years or 40 years? I have less confidence in the monetary system keeping a stability than I do in having a house, which is always going to have that value. That doesn't really change at least. So could you speak at all to the monetary system, the value of currency? How does that affect things?
So right now, since we're a system based on debt, and that the only thing that gives a note of currency value is the fact that someone's going to give you some sort of purchasing power back in exchange for it. Since we're off the gold standard, there's no tangible item they can give you that has value. It's all based on a promise. So since it's all promise, and the only way that everyone can keep moving money with these promises going back and forth, whenever the debts start to increase, the only way to fix it, they have to issue more debt. They have to print more currency. So we just keep adding more dollars, more dollars, more dollars. I think in the past few years, you're talking on the order of multiple trillions. I'm not sure if they've exceeded 10 trillion in the past 3 years, but we may be very close in terms of what's just been printed and added on to the original amount of debt we had, the amount of currency in circulation. It's substantial. As a result of that, though, every time they print more dollars, and it's just easy to print more of them to put them into circulation, that means if you were holding on to it, ideally, you're capitalizing. The only way to win here is to be in debt, because if you're in debt, your debts are shrinking in value, while anything you hold in tangible currency and purchasing power is reducing in value. So the trick of the game they try to put you into in terms of this system to play along with them is to ultimately give them the money to make the money make money, and we're back into usury again.
So what do you think about putting more priority in real assets, physical, tangible things, as opposed, or at least prioritizing that first above retirement accounts?
I would say tangible assets and serviceable skills have an extreme amount of value because of the fact that they work even when the money doesn't. And if and when the currency would finally fail, because at some point it will. No currency has ever lasted throughout all of history. Go through all of the historical things. Let's just look at the Bible as an example. And whether we're talking drachmas or talents or just go whatever they are, right? There's all sorts of different things, whether it's units of currency or types of currency held by countries that don't exist anymore, whatever. If and when the dollar would fail, we're going to move on to a different currency. A tangible item, however, doesn't care what currency is used, and or when you bartering ultimately fits the same bill, right? You can barter a service and you can barter a tangible item. But the thing is, if the currency becomes worthless, like we've seen, Germany was a good example post World War I when their currency collapsed, the Weimar Republic. Or you look at what happened even in the founding in the United States, whenever there was currency being printed by the states themselves that had no value. So the paper was worth more than what they promised to back it with, because it was just a promise. And that is what we're dealing with right now with our current currency. So you have more chance of losing by holding on to the currency than you have by holding on to a tangible asset that will gain in value and will be exchangeable for any currency that anyone could imagine.
So now, isn't there what do you is there anything you can foresee or forecast in terms of the American dollar because of the world economy as it is? I mean, we've got a war in Ukraine with international ramifications. We've got China as a world economic power, and we're in debt to China. Um, do you see the dollar failing in our lifetime? What do you think?
I would, if I had to go and bet, if someone's going to say, hey, $1,000, that's what you got to put your money down on it. I bet on the failure personally, mainly right now with everything that's going on with the de-dollarization we're seeing when it comes to oil. We're seeing the movement and the growth of the BRICS alliance, that forging of alliances, or that it's not really a federation of nations yet. Nothing as strong as what the U.S. Constitution tried to do, or the European Union, but BRICS is closing in on that. They're talking about making their own currencies. The Russians are looking at backing their currency with actual gold. So when those things start to change, and we no longer have a petrodollar, and we don't have any gold backing, and we don't have a bunch of people who need our money, and the people who did need it, whichever countries they were and whatever businesses they were in, if they're starting to dump the dollar and it has no value to them, then we have a much higher probability of ending up like a Weimar Germany, where we just print and print and print, and the dollar itself is worthless, and they have to exchange it out for something that has value. Then we're in a situation where we could confidently say, oh, the dollar will be here, 10 years from now, 20 years from now. Anything's possible, but my 2 cents would lean towards it's going to go away at some point.
So, and just for viewers to understand, if I'm putting all my money in this retirement account, and I've got 300 grand or something like that, and in 30 years, if the inflation and the dollar collapses or whatever, then the value of that monetary value just could be very, very small. So question here from Wesley. What's the suggestion for investing in tangible assets? Which ones? I'm thinking the ones that I would always need and that my children would want to be passed down to them. Number one would be the house, and then a car. I'm thinking of also the skills of chicken farming. Building a chicken coop, farming skills. What are your thoughts on tangible assets, Peter?
Everything you were bringing up in that set of comments right there were utility tangible items. So there's a purpose for them. So the reason you own them is because they have a physical value to you. There's a function that they're going to provide, a service, a value in and of themselves because of how they work, with your environment around you. So whether it's you have farming implements, whether you have land, whether you have some other series of tools that allow you to do maintenance on things that otherwise other people may not be able to do, or because you can do it well, you can trade that. Again, we're going back to services and items that are not only you can hold them, but they provide meaningful value to other people in there. That's where you win. People talk about gold as a tangible item. And it's like, sure, you could have gold, but okay, say you did have enough money where you had an entire ounce of gold coin, right? Okay, how do you divide your gold coin to spend $100 worth of purchasing power? It's not easily fungible. So you're looking at fungibility of your items, you're looking at the utility of your items, and then what value you're going to receive and the other people could receive from you. So that's why you hold on to it.
Here's another question from Wesley, which goes right into the next area of discussion. If you have no debt except for the mortgage, do you pay off extra on the house or invest in retirement and deferred compensation like the Roth IRA, 401k, etc.? At least in my mind, looking at this, I would want to start paying down the house first ahead of these retirement accounts because I just don't have enough faith in the monetary system. What do you say, Peter?
That's the trade-off, and that's the big question. If you have faith in the system, it's easy to hold the debt longer. Also, there's a chance too, if the system starts to go, there's a chance they forgive debts as well, depending on how bad it gets. So there's anything in the middle in terms of the range. Now, that said, though, traditionally, when you're looking at a financial planning, kind of how, from that perspective, how we move forward, ideally, what you're looking at is what is going to give you the most return. And if you refinance your house or purchased your house prior to all the increases in the interest rates, it's almost better to leave the debt in the house, pay the minimal payment, and then take your money and use it on something else that you can get a more reliable gain.
Okay. Tell us about retirement accounts. So right now I've got a 401k and a Roth IRA, but I'm thinking about emptying it to put it in something else, invest in more real assets for two reasons. One, because of the evils of the stock market, and I just don't want to be a part of that. But
Mhm.
two, because of my lack of faith in the monetary system. So can you speak at all to retirement accounts? What are your thoughts on the 401k and other options?
I'd have to say, as of late, my opinions have changed greatly on them, and mainly understanding more of the financial vehicles that are out there and the regulations surrounding them. When you have money in a bank and the money sits there, there are fewer terms on your ability to access that money than there are on a retirement account. And the only advantage the retirement account is then providing to you is a deferred tax and the potential for growth. The problem is that the way that the tax code is set up, we get 10% penalties for any one of us who is under 59 and a half, and we withdraw money early from everything other than a Roth. And a Roth, it's only if you try to withdraw your profits early will you get the penalty. But when it comes to 401k, IRA, that type of stuff, they're going to try and take money. You're going to get a 10% penalty if you take it early. And on the flip side, say you were in a really good financial planning mode when you were younger and you got everything all squared away to the point where all your debts are paid, you're not going to need your money that's sitting in that IRA or that 401k. IRS doesn't care. They're going to force you to start pulling your money at 73 anyways. And then as they work through the tax rate, or sorry, that the rate of withdrawal will increase, likely the tax rate will increase as well. But the point being is you're going to end up having to give the IRS their cut regardless. And when you would pass away, your money is still going to end up being taxed by whoever inherits your money at some point. One way or another, they're going to get the tax on those dollars that were earned that they haven't been taxed yet. So the question is do you pay your taxes now or later? That's all you're really putting together with the deferred accounts, those retirement accounts made by the ERISA.
And that's another aspect of it is that we know that the inflation is constantly increasing, and then the taxes are constantly increasing, which are related. So, and then the monetary value is decreasing. I don't know what's gonna be, what's my money is gonna be like when I retire. What kind of you mentioned to me in person this whole life policy option. So what alternatives do you offer at Knights of Columbus?
So when you're looking at retirement planning, you really have effectively three buckets of money that are available to you or that you can build over time. And you're talking your 401ks, qualified retirement accounts, IRAs, that type of stuff that has all the weird tax treatment on it, has all the market risk usually in there, et cetera, but you're going to pay the tax on it down the road. You have non-qualified savings, which would be like your bank accounts, your tangible assets, your things that basically are just straight up. They are what they are. They may grow, they may do whatever, but usually they're relatively secure. You're not trying to roll the dice and play the casino that is the stock market to try to see if you can get more money. And those are pretty straightforward, but it's just cash. And your last are your insurance vehicles. And your insurance vehicles, now you're looking at annuities and whole life insurance or cash value life insurance, where you can actually gain value in your name in a way that is I would say tax favorable. So annuities are tax deferred unless it's a Roth IRA annuity, or you have the ability to use whole life insurance, which actually has no taxability on it if it's built properly in accordance with the Internal Revenue Code.
Okay, so what would you say is the best retirement account option? The whole life?
So, one of the studies I had read recently, it was done in 2019. Ron Carruthers did it. He compared the 401k and the whole life insurance, like permanent life insurance, and said, based on what are we looking at in terms of the performance? And when you look at the performance of whole life insurance from a decent company that you can rely on, your cash value growth in a whole life insurance policy ends up being comparable to that of a 401k when you factor in the fees that are attached to 401ks, because so one way or another, the company managing all the money of your company is going to have to pay the money manager. So that's going to take money off the top. It will lower the profits that are coming back. Plus, the thing that a lot of financial planners do not address is sequence of return risk. And everyone felt it in 2022 who had to withdraw money on a down market. You can talk all day about getting 12% return this year and a 15% next year and a 7% the next year and whatever. And you're like, but when I take it out, it's going to be great, right? Until you end up with a 2022 situation and you lose 20% in your account. And now all your future growth is damaged because you had to pull out money at the bottom, which is the worst. So by contrast, what you're trying to figure out is a way that how can I gain money, minimize my risk on the storage vehicle, and the way to do that is you use whole life insurance to grow money consistently and not have to deal with the tax treatments or any of the IRS limitations on accessing your funds.
So can you tell me more about what exactly is the whole life policy? How does it work exactly? So you're saying that there's a tax. Just break it down for us a little bit, as I'm not familiar at all with the whole life and policy.
So when we're dealing with insurance, so I'm going back to kind of finishing the answer for your previous question, in terms of like a company like the Knights of Columbus, because there are other companies out there, they offer some sort of life insurance, whether it's term. They're going to have it because it's the easiest, and that's the one everyone understands. A period of time, you're going to get some insurance, but it's pure death benefit, and you get very little side benefit. Meaning, if you outlive your term policy, you get nothing other than you spent money, and there's sorry, you outlived your policy. So go you're alive, but you gave us money.
Okay, let me just explain that so that I understand. So term life is like 40 years. So I'm going to put money in this thing for 40 years, but then if I don't die at the end of 40 years, that money it's gone and I don't get it.
That's correct.
That what you're saying?
Yep.
So that's a term life. So you're kind of rolling the dice as to when you die, basically, because you're just going to.
Yes, but you will not have access to term policies after you exceed a certain age that will be affordable. So there are companies out there that will take advantage of the elderly and try and sell them policies, but you're talking within 3 years, the elderly person who's taken out this policy for an elderly person, especially over the age of 70 or 80, what ends up happening is within 3 years, one of them that I'd seen recently, the insured will pay more money into the policy than they'd even get back in death benefit. It's almost no point to it. So term expires. By contrast, whole life, permanent life insurance is designed never to expire. So only like 2% of term policies are ever exercised. So you're talking 98% of people are going to outlive the term insurance versus whole life. They're designed so 100% of the policies pay. And whole life has cash value attached to it. And it has that, like I said, tax favorable treatment as long as you build it over multiple years with a set schedule of payments. And the IRS basically deems it, and you can tell when you set the policy, the IRS will deem it a tax-free policy or a modified endowment contract. Unfortunately, it's complicated, hence why people like us have to do this job. And we can go back and thank the IRS and Congress for putting together the Internal Revenue Code, as awesome as it is.
Okay. So one easy benefit is that it's a tax-free account.
Yes.
That's the whole life. Okay. So I'm putting money into now. So I must put it in pre-tax then.
So no. So in this case, the way that the IRS agrees to not put their hands in the pot is you're going to agree that you're going to ultimately put in a premium for more than 7 years. So you're talking, say, 10 years. You're going to agree you're going to pay X amount of dollars for that time period. It will not change, or it's going to vary a little bit, maybe, or it's locked in. And then after it's all paid off, it was after tax money. So you didn't have anything you owed to the IRS, and they're like, cool, you can do whatever you want with it. And then when you take any of that cash value out, which it's usually it's a collection of the premiums you've paid in, you can use that money for whatever you want to use it for, and it doesn't count against your income. It does not increase your taxes. And then in the end, it's more like a loan against that policy than it is income. And then in addition, that cash value, not only did it add up ultimately to the premiums you've put in at some point, they all have built-in growth schedules to exceed the amount of premium you've paid in. And they're dividend eligible, so they'll get paid dividends as well. So you can make a little bit of money inside this policy that's not taxable. That's the best part of these things. So they end up being like an amalgamation of a Roth IRA, a savings account, and life insurance all in one vehicle. And so your goal is to try to say, hey, how can I design one of these to complement the rest of my retirement assets? So at least some part of my money is not taxable and not subject to the market risk.
So if I've already paid taxes on the money that I put into the life policy, if I already paid taxes on it, then I put it in, how is it tax free? I don't understand. When you take it out again, it doesn't count against your income, but it already counted against your income when you put it in, right?
Yes, but think of it like when you look at a CD or a brokerage account. So if you have an investment account where you're buying stocks and the stock appreciates in value or you make dividends on it, those are going to be gains that are taxable according to the IRS. And you're going to get a 1099 that comes back. It's going to say you owe money to the IRS because you earned something. And if you get the CD, same thing. You put it in for a 5-year CD, every year you're going to get another tax hit back to the IRS because you got to pay because you made money off it. So yeah, you can see right now these CDs are paying like 5% and stuff like that. Great. But the thing is, what do you take home after your taxes come out? So it's the same argument that someone would have for why the stock market is not good for us to play in. Is the same thing of why would we be playing in the banks game either, because they're doing the same thing and they're doing equally shifty stuff, all to make money, supposedly to give it back to us. And they're hurting for liquidity right now really badly.
Okay. So I get that. So the growth of the whole life policy is not taxed, but the premium that I put in is taxed. So there's a tax-free aspect to it. But how does the whole life policy grow then? Don't they invest this money to make it grow?
They have to invest, because the thing is like, even with the Knights of Columbus as an example of a company, so not-for-profits out there and mutual companies are designed, they're trying to take care of their members, whoever they are. So whatever, name the company mutual or it's a fraternal company, wherever they are, because there's a bunch of them out there that are oriented towards particular groups of people. They're trying to take care of those individuals. How can they make money, especially when you're looking at a not-for-profit as an example? They have to find a way to take that money so it continues to work in the meantime. And so whatever the investments are, there's ways you can invest that in terms of putting your money into companies that share the moral values that ideally we would share as Catholics, right? And so from that standpoint, they can actually generate more money, because we can only go so far on the premiums themselves. And whoever gets an insurance policy is really banking on the fact that we're going to pay out the death benefit. So if we're going to pay the bills, we got to find a way to make sure we can guarantee that insurance is going to pay out. Otherwise, people don't get insurance, and it's not insurance if you can't rely on the fact that it's going to be paid when you need it.
So if I do a whole life policy with Knights of Columbus, they're going to be investing the money in as morally good as possible. Everybody's tainted at some degree of causality, unfortunately, but so they're going to be investing the money in Catholic approved sources and whatnot. But I get some kind of guaranteed growth. How does that work?
Basically, because what they've done is they found a way that, whether it's bonds where they're going to just pay interest indefinitely, or it's other like dividend paying stocks, that type of thing, there is growth that's just factored in depending on the conservative nature. Basically, I should say the nature of the investment, ideally the more conservative, to guarantee you're going to get gains. I mean, there's way risky things you can invest in when it comes to shorting stocks and ETFs and all the other stuff where you can start taking derivative value from different stocks, companies, name the other weird activities, and then mortgage-backed securities, as an example. There's all sorts of things you could do like that. Well, the insurance companies, ideally, you don't want an insurance company that plays in those things. So not only are we talking, we have a moral component, we don't want them investing in companies that are immoral and disgusting. We also don't want them investing in stuff that's just risky, that if everything turns the wrong way from the bet that was made, you can wipe out your assets quickly. So from an insurance company standpoint, it has to invest in something that's going to bear dividends, regular interest, that type of thing.
And what is the, whereas the 401k, I can't access my money without a penalty before I'm 59 and a half. Mm-hmm. When can I access the money in the whole life policy?
You can access the money in the whole life policy as soon as your premium starts to accrue cash value. So for instance, you're going to put in, say, a premium, you're going to put in $500 a month or something like that as part of your savings plan. Well, what happens is up front, you got to look at it kind of like a mortgage, in that when you go and buy a house, going back to things that are in terms of the way that's totally criminal about our system, but it is what it is. Here we are. You pay interest up front to the mortgage company, to the bank, for the privilege of living in your house and the fact that they loaned you the money up front. So you're paying it off. And in the end, you're looking at interest that over time goes down while your principal payments are going up. So the amount of principal is increasing. In the same way, an insurance policy, whole life insurance, is designed so that as you pay the insurance up front, what happens is the insurance costs go down over time, and then over time, the cash value amount of your premium goes up. So you're getting more and more dollars of your premium that start going into savings. So ideally, by the end of your payments, you're actually just putting in dollar for dollar. Every dollar of your premium is being added to your cash value, which means now you can access, say, up to 90% or whatever their limit that they put on it. You can get almost all of it back out in days if you need it to go and purchase things.
Okay. So in what kind of time frame would that be, I guess? Like, is that like in 10 years? Is that in 20 years?
So all of those are situationally dependent, especially when it comes to the insured and the purpose of the policy. So like I said, that there's term versus whole life. Well, terms people get usually because they're looking at paying off debts in the event of death. Well, by the time you get into whole life, now we're not necessarily looking at only debts. Now we're looking at the potential for debts. We're looking at potential for a way to shelter money from taxation, because all death benefits of life insurance, as long as they're under the estate tax limit, the threshold there, they all come into the beneficiaries tax-free. So what people do is then you can try to take money that was otherwise going to be taxable, because if I planned really well, for instance, and I have money sitting here, there, and everywhere, I have businesses and whatnot, and it's all going to get passed on. Well, the thing is your liquid assets, if you put that into a life insurance policy, you can then shelter that from taxation when it goes to children or anyone outside of basically your spouse in the event of your passing.
So this depends on what I set up, basically.
Yeah. So, and that's the thing. So from sorry to cut you off. There's a businesses will get it because you can do cross purchase buy sells. There's ways that you can get it. So when someone passes away, then that family will get bought out of their share because the head of family passed away. So the business will buy them out and give them a death benefit to cover their portion of the business. And that way, legally, the business keeps operating and there aren't legal disputes at the end. And there's all sorts of things like that. So then when you build a whole life policy, especially if cash value is what you want, we're not even talking about building it for the death benefit as much as we're talking about how much money can I sock away in that dividend bearing account for future use. And then now the death benefit becomes secondary to the cash value itself. So there's that in there. And then the other thing too, that I know there are going to be people who may ask it, well, what about these universal life? Because there's a handful of companies out there that offer universal life policies. Specifically, the ones I've heard about a lot lately are the indexed universal life. Universal, when you think of universal life insurance, all it is a combination of term insurance and whole life. They mixed them together. And what it does is in the middle of the policy life, it'll have some cash value, but to keep the policy alive later on in life, what'll happen is the cash value gets eaten for the death benefit. So universal lives end up with basically no money at the end. And then the index, when it's an IUL, the index policies mean they're attaching some of the performance of that policy, the gains in the policy, to the market. So we're back into market tied assets again. So just in case anyone was wondering.
Okay. Here's a few questions. Adrian says, does the Knights of Columbus have a moral theologian on staff to help guide the investments?
Yes, this is correct. So we actually have priests that are working with us when they do evaluations and whatnot. So it's a unique feature of that company, and it's not necessarily the same for others that are out there. But it's an advantage because the end state is you end up having a Catholic company. And just like there are Catholic companies out there that do it, Thrivent does Lutheran type stuff. There's a handful of others out there that align to people's moral views, which in this day and age with the fun that we're having on the political spectrum, it becomes much more of an issue for those people trying to save according to their conscience and their morals.
Mm-hmm. Yeah, I really liked I just joined the Knights a couple months ago, and I was interested in life insurance and just the Catholic fraternity that was created over a century ago to help support families so that I can be a part of the Knights to provide for my wife and children if and when I die. And I have much more confidence in, it's like kind of the investment in people aspect. I want to invest in people and relationships, and then tangible assets. The first two are the most secure in my mind, and then all the money in the retirement accounts, which are the least secure but also important. So I feel more secure with the Knights as opposed to some secular retirement company. Here's a few other comments and questions here. Vale says, my employer matches to the retirement account. Is that matching not just free money worth having?
So
on the match.
When we do our advisory with clients, we always recommend if your employer is going to pay you money, take the money because it just increases your salary. I mean, we're all working for a salary, and as cool as it would be to not be in a system based on usury and debt and everything else, here we are, and we have to have a way to kind of to detach ourselves from the system. So if they're going to give you the money to go and add to your balance, we tell our clients to take it, because the thing is it's free money. Now, when you exceed that amount, now you're adding, unfortunately, to a risk in your account that is unnecessary. And that's where we'd say, in terms of your excess over and above the base of your 401k, find some sort of asset that has a lot of reliability in terms of the fact that it will go up in value. Ideally, it is fungible and or spendable. So again, it could still be liquid. And that's why I would say whole life insurance ends up being a really good complement to a 401k after you've hit that threshold of the match from your employer.
All right. And Chris mentioned the fact that he invests in real estate. Thoughts on real estate as a tangible asset?
I think real estate's a good one, especially if you can generate revenue off of it. There's a lot of value there. We'll see how everything goes in terms of the system itself and what's supported. And I know that some states are more difficult than others to actually maintain that revenue, depending on how they treat the renters. Because you can have, I know like states like Ohio, for example, can be really rough on the landlord, in that they'll allow the non-paying renters to just sit there and squat for a period of time before they'll even get involved with a court. So that's one of the things to consider on a risk thing, is you just want to make sure that you're evaluating all of your risks. You diversify as much as you can. And the main thing when we say diversify, just don't think about just diversifying your investments by holding multiple companies or multiple mutual funds or whatever. Diversify outside the market, hands down. And if real estate's one of the ways to go, do it. Whole life insurance, it's another way to go. Your own personal skills, your own personal businesses, those types of things have a lot of value as long as they're addressing individual needs of your community.
Okay. Addressing individual needs of your community. That's good. Another question from Wesley: is whole life insurance more expensive up front?
It's a very interesting product in that it ends up being a net zero cost. Because let's say, for instance, you did have a premium. We'll go back to the $500 a month, and you're putting that in. So overall, it's going to add up to $6,000 a year, right? It sounds like it's going to cost a lot of money. It's really expensive, except for the fact that you're talking about a product that's still going to be there when you're in your 90s. It's still able to go and pay, and it will grow. And then the cash value will be more than what you actually put into it. So you didn't actually lose money. It was a delayed growth compared to what people expect to see out of like a 401k or a market type investment. But in the end, it's not really an expense. So if you look at moving money from a checking account to a savings account or vice versa, or you're going to move to a money market account and you're going to bounce back and forth with your bank, you don't look at that as a cost. You're just looking at it as I'm moving the money into the other account. And whole life ends up being a very similar thing. So if you're saying I'm going to move $6,000 a year over into my whole life, then you're just doing that. It's just upfront. They're going to use part of that money to cover the insurance costs, but down the road, dollar for dollar, all of that's going to hit your cash value. You will end up with more money in that account than you put in, and it will reliably grow with no additional tax burdens for you. If you're trying to stay under an income tax threshold or maintain some other access to your money prior to that 10% penalty coming off of any other qualified assets, life insurance is the mechanism to sit there and say it's probably worth the upfront shifting of resources or locking those resources into that policy so you get those features down the road.
Okay. Now I've got a 401k and I have a Roth IRA. I do not have a whole life policy. But the other thing is I'm not currently contributing to any of these retirement accounts because I can't make the monthly payments, and I'm not with the company before. I was with a previous company. So, but what should I do with this 401k? If I want to take it out of the 401k, I lose 10%, which is, and then I got to pay taxes on it. So I'd lose a bit out of it if I were to put it into tangible assets and or whole life. What do you think about transferring a 401k with these penalties up front?
So when I've seen situations like that before, and we talk to our clients about it, we can either fight the system or go along with the way that the code has been established so that we can ultimately get something from it. So like when you have like an orphaned Roth IRA, 401k, something that you didn't do anything with, you're not really sure what you want to do with it. You're not even sure if you want to contribute more to it. You may want to get some gains out of it. You're not sure. One of the things you can do is you actually can throw it into an annuity, and the annuity will actually maintain that value at a minimum. And depending on who you take that annuity with, those annuities have guaranteed returns. So you actually don't end up having to take any penalty because there's no taxable event. You left it in that same qualified bucket. So if it was a 401k, you can literally roll it into an IRA annuity, no taxable event, and that money just sits there and grows, and it basically goes on ice, but you don't have to do anything with it. And that way, then when it comes time, you can use that money, turn it into an income stream, because think of an annuity as a build your own pension plan. So you have those options with insurance. And then I guess the only way you'd even consider trying to pull your stuff out of the market is if you really want to think that the market's going to turn any day now. But the problem is since we can't guarantee or time the market well, you have much more risk of just losing your money by pulling it out unless you have some guaranteed return. And there is almost no guaranteed returns out there except for the insurance products. Those are the only ones where you can sit there and be like, I can guarantee you it's going to be this much return over this much time. Otherwise, it's all a gamble. We're rolling dice and saying, well, it could be worth more. It might not be, but we'll see. So I would say work within the tax code, and you have ways to do it. But annuities are the easiest way to sit there and go, let me just put this money on ice while I figure it out, and then come back to it later, and then just don't add any more to it if you don't feel like it. And you can always work that into your plans down the road.
Okay. One more question here from Jim. How does whole life hedge against the devaluation of the dollar in ways that market money does not?
I'd say two things that you're looking at there is that you have the growth in the policy over time. So what happens is that because whole life insurance is a dividend paying asset, what it's doing is when those dividends hit your account, and they're not guaranteed, but the companies will pay them and they'll offer them, and they're pretty frequent. The end state is that those dividends, when they hit the account, they'll buy additional insurance benefit. So not only are they going to now be added to your cash value balance, and they're going to earn dividends as well. They're actually building the value of the death benefit at the same time. So if you take out $100,000 policy today, but you keep paying into that thing for the next 30 years, you're going to have a policy that's probably going to be closer to, say, a $200,000 death benefit. And it just kept growing because of those dividends paying in, and the paid up additions is what they call them. But the policy grows in value. So where a term is just locked in, you're going to pay a set of money to get this one benefit, and 20 years down the road, it expires and it didn't really change or anything. Whole life, every time you're getting those dividends, you can actually have the death benefit growing. And the other thing I'd say too is that how you're hedging against the market value stuff, not having tax is huge because if they keep playing with the tax numbers and they keep playing with what the brackets are going to be in terms of where you're going to pay X amount of tax increased, the being in a tax-free asset alleviates all of that risk, which means your money just goes up, which is much easier to deal with than finding out what the taxability situation is that you're going to have to look at when you pull the qualified money out. And again, from the death benefit side and the cash value side, it's still going to keep growing indefinitely to help out that value go a little farther.
Okay, excellent. Well, Peter, thank you so much for all of your conversation today. Any final thoughts on modern finance evils, how to avoid them? Final comments.
I think the market is rough. I think that it has a facade that everything's going to work out. Everything's going to be awesome. And unfortunately, I should say the majority of us have been lulled into, hey, go and throw our money into it. But it carries with it a lot of risk. And so whether that risk comes, in terms of a financial sense, we don't know whether it's going to grow or shrink or whatever when we have to withdraw that money. That can be difficult whenever, like they said last year, what we watched, whenever the values dropped fast, it jeopardizes the financial planning that we're putting in place when we can't guarantee what the returns are going to be tomorrow. And then secondly, I'd say the other risk we have is a moral one, because we do know what some of these companies are doing. They're literally telling us they're doing evil stuff. And whether it's actually the company itself, and name the big company and the what they do online or wherever they do it in public and all the other stuff they promote, or the brokers themselves or the banks that are doing the same thing to promote it and profit off of it, all of those entities were playing into their game. So ideally what you're trying to find moral companies out there that align to the moral teachings that you have to live by and that we have to die with so that we can go to heaven. And then everything else will balance out. And there are companies out there that can help you live and align your finances and your faith. So have hope in it. There are ways to make it work.
Excellent. Thank you so much, Peter. Well, let's end with a Hail Mary, offer it all to Our Lady, and ask her to guide us in this navigating these complicated things of modern finance. Let's pray. In the name of the Father, and the Son, and the Holy Spirit. Amen. Hail Mary, full of grace, the Lord is with thee. Blessed art thou among women. Blessed is the fruit of thy womb, Jesus.
Holy Mary, Mother of God, pray for us sinners now and at the hour of our death. Amen.
In the name of the Father, and the Son, and the Holy Spirit. Amen. Jesus is King.